Definitely, GCC macroeconomic profile is dependent on the oil price, and the oil exports constitute a major parts of the exports. But in the last decade of high oil prices, the GCC has accumulated enough reserves that it can continue to go on for next 3 to 5 years without any problem. But yes, definitely it will spur a thinking in terms of looking at the capital expenditure projects, in terms of reining in expenditure. But if we feel the oil price remain above, let's say, $60 to $70 a barrel, which is around the break even of the break even for the region, I don't see that will spur the GCC economies to control their capital expenditure, because I think from that point of view, that mega projects that they are initiating is very important for two reasons. Number one, to diversify their economies away from oil, and another one is to create jobs for the young population that is going to come into the workforce. So if the oil prices remain above the break-even point, I don't think there is going to be a major problem, because they have already accumulated enough surplus that they can dig into. And also from the credit profile, most of the GCC economies have a very strong credit profile. So in case they want to dig into the credit markets or the bond markets, they can use that opportunity in order to issue sovereign bonds or any debt products. MENA region is an interesting case, because here we have the oil importers who are going to benefit from the decline in oil prices, and the oil exporters who are going to be affected negatively by the decline in oil prices. But having said that, there is a lot of flows that come from the oil exporters due to, let's say, tourism, let's say expat population that works in the GCC region, that sends the financial flows to the oil importing region. So that definitely gets affected. But overall, I see that the producer and consumers across the world are trying to sort of balance the prices so that there is a sustainable economic growth. And in the whole MENA region, there is a huge amount of subsidy payments that are being paid by the oil importers as well as exporters. And if we can sort of balance the oil price, that will take care of the offsetting mechanism. So we are looking at the oil price in the range of $60 to $75 a barrel in the medium term, looking at the demand supply situation in the energy markets. And I think that will be a good balance for the GCC region, so that they continue their spending on the projects, and on the oil importers, so that they can reduce their current deficit and the fiscal deficits and be in a more stable credit situation. Number one is, if you look at comparison between the global credit markets, the credit markets of MENA region and especially the GCC region is minuscule. Many of the credit market is just the bank financing, and the equity market capitalization is many times bigger than the debt markets, which is the reverse case in the global emerging markets or the developed markets. So one thing that I see from that this conference is definitely that the region should look at accessing the debt markets. There will be more debt issuances, and especially from the sovereigns, because when sovereigns issue the debt, it creates a yield curve on which the corporate bonds or the financial bonds can be priced in. So what we are looking at is that there will be more issuances from the government side, so that there is a good liquidity, because again, MENA bond markets is mainly buy and hold. There is no much active secondary market, because primary and secondary markets complement each other. So once we see a good amount of issuances, the liquidity also will improve. And from the asset allocation perspective, debt market is the most important market, because that provides a more stable and less volatile returns. So whether you are talking about a retail investor or an institutional or a sovereign wealth fund, we need a very strong debt market in the region for the efficient asset allocation. Number one is that the debt issuances need to increase, and the leadership role will have to be taken by the governments. That government will have to issue more debt. And then another one is the liquidity has to improve, because investors are looking for debt securities in order to let's say optimize their portfolios, and also try to get adjusted returns, generate efficient portfolios. So we need a strong secondary market also, so that they can make sort of risk adjusted returns on the debt. And the corporate and the financials will flow once they see that there is a huge acceptance of the debt market and the liquidity is good. So we hope that this will bring more issuers, underwriters, financiers, as well as regulators in order to create a more deep and efficient debt market.